What if I told you that China is quietly making a move that could potentially send Wall Street into a panic, and the mainstream media isn't even paying attention? Today, China is dumping US debt at an alarming rate. And while everyone is focused on the next big tech IPO or earnings report, the true risk is hidden in plain sight. What does this mean for you, your investments, and the global economy? Well, let's break it down. To start, let's understand how China's financial maneuver could be a game changer. For years, China has been one of the largest foreign holders of US Treasury bonds. In fact, at one point, China's holdings peaked at over $1 trillion. This meant that China was deeply invested in the success of the US economy, relying on the US dollar's strength and the stability of US debt to fuel its own growth. But recently, things have changed. As of late 2025, China's Treasury holdings had dropped to around $682 billion. This is one of the lowest levels in recent years. So why is China reducing its exposure to US debt? Well, it's not a simple case of them just deciding to divest. It's more about China positioning itself for a shift in global finance. By offloading US Treasuries, China is looking to reduce its reliance on the US dollar and hedge against potential financial instability in the US market. China's decision to cut back its debt holdings is not just about diversifying its assets, it needs us about reducing its exposure to the US financial system. But the ripple effects of this move are far-reaching. First, let's talk about the impact on US Treasuries. If foreign buyers like China and Japan stop buying US debt, the US government may need to rely more heavily on domestic buyers. That could push US Treasury yields higher as the government has to offer more attractive returns to entice investors. Higher yields, in turn, lead to higher borrowing costs for the US government, businesses, and consumers. If borrowing costs increase, this could slow down economic growth, especially if inflationary pressures persist. But that's not all. This shift could also impact the value of the US dollar. With fewer foreign buyers of US debt, the demand for dollars could decrease. As a result, the dollar could weaken, which could trigger a series of global economic shifts. A weaker dollar could make imports more expensive, leading to higher inflation. And for countries that rely heavily on the US dollar for trade, a weaker dollar could create serious problems, especially for emerging markets with significant debt denominated in dollars. So, what happens next? Well, the US Treasury is set to release new data on February 18, 2026, showing who's buying US debt. This will give us a clearer picture of just how much China AES actions have impacted the market. But here's the thing. Even with China dumping treasuries, we haven't seen a massive spike in US yields or collapse in the bond market. Why? It is because the market hasn't fully priced in the consequences of China's move just yet. If foreign buyers like China and Japan start pulling back even more, the US could face a serious liquidity crisis. The market might not realize it immediately, but once the data comes out, we could see a dramatic shift. And if yields start to climb, this could send shockwaves through the global economy. Stocks, real estate, and other assets could take a hit as borrowing costs rise and economic growth slows. But there's more to this story. China's decision to dump US Treasuries is just one part of a much larger geopolitical strategy. By reducing its reliance on US debt, China is positioning itself to decouple from the US financial system. This is a slow-moving shift, but it's one that could have massive implications for global trade and investment. As China builds up its own financial power, it's trying to create a new world order, one where the US dollar doesn't dominate global trade. And if this trend continues, it could change the way the entire world does business. Now, let's talk about how this affects you and your investments. For one, if US Treasury yields rise, it could make other investments less attractive. Stocks might struggle to gain momentum as higher yields make bonds more competitive. This could be a particularly tough situation for high-growth sectors like tech, where valuations are already stretched. But the real action could be in commodities, particularly gold and silver. As the US struggles to find new buyers for its debt, we could see precious metals start to shine. Gold and silver are often seen as safe haven assets during times of financial instability. And with the dollar weakening and yields rising, more investors might start flocking to these assets. In fact, we're already seeing signs of this. Gold and silver prices have been volatile recently, reacting to changes in US Treasury yields and expectations for future rate cuts. If China continues dumping treasuries, we could see these metals continue to rise, especially if inflation continues to be a concern. So, what's the bottom line? China's decision to reduce its holdings of US debt is a significant shift in the global financial landscape. While most of the world is focused on other issues, the impact of this move could be far-reaching. As China reduces its exposure to U.S. debt and other countries like Japan step in to fill the gap, we could see rising yields, a weaker dollar, and a slowdown in economic growth. For investors, this means paying close attention to the bond market and looking for safe haven assets like gold and silver. And if the data from the U.S. Treasury comes in as expected, the next few weeks could see massive volatility across all asset classes. As China continues to reduce its holdings of U.S. debt, and as the global financial system shifts, one thing is clear. The world is changing, and the future of global finance is no longer as reliant on the U.S. as it once was. The implications of this are far-reaching, and the market has yet to fully grasp the extent of China's silent attack. What happens next could reshape the entire financial system as we know it.